We'll make a start shortly. Just letting a few more people in before we begin. All right. I think we're about there, so let's begin. Well, good morning, good afternoon, good evening, everybody. Welcome to our webinar on ECL models under stress, addressing emerging macroeconomic and geopolitical risks. Very timely, if I don't say so myself. My name is Polly Sang. I'm the Senior Financial Services Regulatory Manager in the Financial Services faculty at ICAEW. I'll be your chair for today's session. We very much encourage you to get involved with today's webinar. You can submit your questions to us at any time by clicking the Q&A tab on the webinar and typing a question into the question box and pressing submit. You'll be able to interact by upvoting other questions, and so please keep your questions coming in throughout the session. A link to this webinar and a copy of the slides will be sent to you within 24 hours of this live webinar. You can also use the question box to let us know about any issues regarding the technology and any difficulties you might be experiencing. We will do our best to help with these. This webinar has closed captions enabled. In order to enable this feature, please click on the CC button at the bottom of your screen. Please note that the transcript is automatically generated and errors may occur. Before I hand over to our speakers, I just want to take a moment to remind you that the ICAEW CPD has changed. A copy of this webinar booking confirmation email is accepted as evidence of verifiable CPD. You will need to save the email as a JPEG or a PDF before uploading it to your CPD record. Please visit icaew.com/CPD changes for further information. Now, please let me introduce you to our speakers for today's sessions. First off, we have Vivian Legan, Managing Director, Model Risk Management and Co-Source Services, Financial Services at Grant Thornton. With over 20 years of experience in the financial services industry, Vivian has excelled in developing and leading cross-functional teams and projects. Vivian has established strong relationships with clients at senior and executive levels to evaluate and mitigate market, credit, and regulatory risks. Next up, we have Jatin Kalra, Partner, ECL Modeling at Grant Thornton. Jatin Kalra is a partner at Grant Thornton in Mumbai, leading the ECL modeling solution offering. With 16 years of experience, Jatin specializes in financial services, providing ECL modeling and accounting advisory services. He has led over 75 engagements across various countries, including the UK, Australia, Singapore, and more. Jatin is passionate about tech-enabled solutions and has extensive experience conducting workshops and training sessions on ECL and related topics, training over 1,000 individuals globally. Finally, but not least, John Munglard, Associate Director, Model Risk Service, Grant Thornton. John leads Grant Thornton's internal audit reviews for bank and building society clients, covering areas such as credit risk, enterprise risk management, operational risk, capitalization for risks, model risk management, and climate risk oversight. With 15 years of regulatory experience at the PRA, John has supervised various banks, including Nationwide Building Society and Lloyds Banking Group, and led assessments of internal audit, governance, and risk management. Now, please let me hand you over to Vivian to begin the presentation.
Thank you. Thank you, Polly. Good morning, everyone. I'm delighted to welcome you to our webinar today, where we will delve into the impact of macroeconomic and geopolitical risks on ECL models. For those unfamiliar with Grant Thornton's quantitative risk services, let me take a moment to introduce our services. We are a global leader in quantitative risk with over 200 dedicated quant risk professionals across our diverse geographies. Our team is embedded in major banks across the UK, Europe, and India, providing services in model development, validation, complex analytics, and valuations. Next slide, please. As Polly mentioned, we have led over various ECL projects with over 70 plus clients. And in those projects, there is a common thread across those projects, and that being the challenges of global markets, including macroeconomic changes, geopolitical tensions, fluctuating interest rates, rising recession risks, making robust ECL models more critical than ever. So we're really excited today to join you to have a discussions from the engagements and share insights from our projects. As you would expect, in our recent discussions with our clients, has also focused on the impact of US tariffs, highlighting sector-specific risks, market volatility, and potential default consequences. But all of these impact our clients, different banks, and portfolios in very unique ways. Consequently, in our discussions, we're encouraging clients to conduct thorough bank-level evaluations to accurately quantify these potential impacts on ECL models. So very excited today. We're going to explore some of these themes with you, hopefully equipping you with insights and strategies to enhance your understanding of how to adapt ECL models effectively in response to these evolving challenges. So thank you again for joining us today, and let's get started. Next slide, please. So today's agenda, we're going to go through regulatory landscape, including the PRA and EBA expectations. We'll then move on to overview of the ECL risk management process and the significance of model monitoring. We'll look at where and why ECL modeling can go wrong, the impact of evolving macroeconomic and geopolitical risks on ECL models. We'll wrap up with the role of PMAs in bridging the gap left by statistical models. So to kick us off with the first agenda, I will now hand over to my colleague, John.
Thanks, Vivian. Good morning, everyone. My name's John Mongard, and welcome here today. I'm just going to do a bit of scene setting, talk you through the important context in a highly regulated sector in financial services. We need to understand the background for the regulations that may apply. And I'm going to talk about the model risk regulations. Those of you who are less familiar with ECL model and modeling, let me just, again, do a bit of background setting. So an ECL model doesn't typically tend to be one sole model. There'll be a suite of models. So there'll be a probability of default model. What's the chances of Mr. Smith defaulting? There'll be a model to estimate that. There'll be an LGD model, a loss given default. What will be our loss if Mr. Smith defaults, 50% say? And there'll be an exposure at default modeling. What will be our exposure when we think Mr. Smith will default? So three distinct models tend to be combined together to produce that ECL calculation. And therefore, there's lots of regulations that talk about how those complicated models might be managed. Now, on this slide, we cover some of the regulations that come out internationally to look at model risk management. And it all began top row in 2011 in the US with SR 11.7. And that was back in the day when regulations were only about 1,700 words. So please look that up. It's an excellent reference point. And perhaps where it all began in terms of model risk management. But there's lots of references on this slide, and I won't go through them individually for the sake of time. I would say that you focus on the ones that are relevant to your geography, because they are not always consistent. And the locus of how they apply is also different in terms of the models which they look at and the banks that they apply to. What do I mean by that? We've got in bold here, May 23, SS 123 was published by Bank of England, PRA. And for me, SS 123 is probably one of the best pieces of regulations to come out in the next regulator. I hope you appreciate my views. It says lots of excellent things about how to manage models. But that was initially consulted on and was intended for all UK banks. But through the consultation process and perhaps with the UK growth agenda, its scope has been limited, so it only strictly applies to the larger IRB, those banks that have permissions to use models for their regulatory capital Pillar 1. Nonetheless, as I say, it still says lots of useful things which many may find useful. Next slide, please. So, looking at the audience we have today, probably the most important regulators are the EU and the UK regulators. And I think many might say, well, what stake do the financial services regulators have in commenting on ECL and accounting standards and how they're applied? So for the UK, there is a tripartite angle. There's the role of the regulator, role of the bank and role of external auditors that should be combined. That's a lesson learned from previous crises. And of course, the provisions will have an impact on the PRA's statutory objectives. So maybe extending their remit, but I think all the international regulators have sought to comment on ECL provisioning. Let me just give some higher level views on how IFRS 9 has fared, first of all. So the ISB, the International Accounting Standards Board, actually commented, did a post-implementation review of IFRS 9, which came around in about 2018. And they've found that it's actually been performing very well. They're very pleased that impairment requirements have been worked well in practice, and that's been particularly the case during times of economic uncertainty. So IFRS 9 came along 2018, and then of course we had the COVID period in 2020. And I think we'll go through it later with Jatin. Actually, IFRS 9 has fared very well through that. I'll contrast that with Basel II, which came around in 2007. We then had a financial crisis, and work on Basel III started almost immediately from its inception. But IFRS 9, I think, has fared a lot better, but has not been without comment from the regulators. So the EU published a monitoring report, so not prescriptive in giving guidance yet on how IFRS 9 should be implemented, but they produced this report which has some benchmark information, which I'm alluding to in due course the EBA may want to be more prescriptive about. But themes that they've covered then, significant increase in credit risk, SICA. During COVID, we saw entire sectors that were perhaps put at risk because of lockdowns. So the hospitality, hotel, restaurant sector were at risk. And the EBA is talking about perhaps there's room for collective SICA criteria. So should you move entire sectors and consider those all to have increased in their credit risk, rather than taking an individual assessment of whether its PD has changed materially from 1% to 3%, for example. They've also looked at ECL models and to what extent they have been performing under a very different environment to the data which they were used to build them. So in recent years, we've had cost of living crisis, we've had the Russia-Ukraine war, we've had all those things change the macroeconomic context, and therefore lots of banks have used post-model adjustments, PMAs, to adapt to those things that weren't inbuilt into the models. And so EBA has reflected on those. Probability of default variability, with its ability to see across different banks, the EBA has noted that sometimes for the same counterparty, you get very different PDs across different banks, and they're interested in that information. And finally, there's a comment on forward-looking information. So banks are continue to monitor and develop their models and think about which are the risk drivers and the key macroeconomic variables that they should use. The EBA is thinking about how sensitive those models are to those economic variables. So even in a stress, even under the downside scenarios that IFRS 9 asks you to look at, are we seeing the non-linearity that we'd expect to see from credit risk losses? Is one of their key thoughts. The PRA has also not been silent on talking about IFRS 9. Initially, a number of letters from 2019 to 2022 talking about high quality practices. And I think that more recently, the PRA has refocused and published their medium-term and near-term objectives for IFRS 9. So I'd urge you to look at those letters. They've used written auditor reports to publish thematic letters. Technically, these sit outside the rulebook, but they contain lots of valuable information and lots of insights into IFRS 9, which I'd urge you to look at. I'll now hand over to my colleague Jatin, who will take you through in more detail on these things.
Thanks, Ron. Okay, so we'll talk about the risk management process now. Like, as everyone knows that developing the ECL models is only, kind of the start of the journey. But we're seeing, of course, a lot of banks focusing and a lot of regulators also focusing on what follows after you have built the model. which is about monitoring the results of that model, evaluating if they are performing appropriately, and also considering if there are new risk or new situations which have arisen, because of which you have to make adjustments, either by calibrating the model or through post-model adjustments. And it is in that context that we are going to talk about, how banks are handling it at the moment, and the key elements of today's macroeconomic environment, and how people are addressing those. So if we talk about the model life cycle, you of course have the model development or any change in model redevelopment that you have done. Then it goes through an independent review. Typically, that's what the regulator would expect. And you have a model approval. Then you are implementing and using it. And then this model monitoring process verification, phase kind of ends up starting. What we have seen is that most of the banks, they typically use a model for, let's say, 3 to 5 years. That's when they find the need to redevelop. But it's not that for those 3 to 5 years, the model goes through and it runs in the same manner, and it's, exactly the same model across that period. We do see that people have to recalibrate certain things, make certain adjustments, or change scenarios or change macroeconomic variables, or adjust through post-model adjustment, just to make sure that the model is appropriate throughout that period. And once, typically what we have observed is 3 to 5 years period goes, you look at possibly redeveloping a model. So that's what we have typically seen in this thing. And when do you have to redevelop a model? Of course, that comes through the monitoring process. And when you do a risk reporting and it's identified that, there's a significant model drift now between actual results and, predicted results, and therefore there's a need to redevelop and make a new model. That's a typical life cycle. We'll focus most of all on model monitoring. So if you go to the next slide here, we'll see that the significance of model monitoring, most of all, is that, you make the best of models, you have validated it, everything's fine. But there are changes which happen post that. It might be that the current state of economy has changed. It may be that the business conditions or your portfolio has underwent a change. So it's very important to keep monitoring the results coming out of the model. And there are a range of different tests, both qualitative and quantitative, which are recommended, basis which you can then, create an opinion about how good, how well the models are performing at that moment, and whether there's a need to change anything or not. It is obviously extremely important from a governance and stakeholder accountability perspective also. ECL, of course, is a massive responsibility for banks. I mean, what the standard setters have today said is that you need to predict your future losses. And tomorrow, let's say we are not able to predict them. There can be questions which come that, we failed in our responsibility of being able to predict losses. At that time, it's very important to, have a robust model monitoring, have a robust model validation process in place so that you can justify your position that time we made the right decisions. Of course, the predictions were not right, but it's not because we made the wrong decisions. It's, because of situations which developed later, which were unforeseen. But if we do not have monitoring validation, then of course it's very difficult to explain your situation and your position. And it can then, it is something which can put us at the regulatory risk also from this thing. So governance and stakeholders, for that perspective, model monitoring, of course, plays an important role. So if we move to the next slide now, the key components of ECL framework, John spoke about how ECL, of course, is like a framework as opposed to a single model. And within that, you have all of these separate models. You have the probability of default model. You might have a separate model which converts the 12-month PD to lifetime PD. So term structure creation model. Then you may have loss given default model, EAD or CCF related models. FLI is the forward-looking information, the macroeconomic model essentially. You would have, models for SICR, identifying significant increase in credit risk and staging. And then there are certain other aspects which might also be there, like prepayment modeling and other stuff which might be there. So you have all of these sub-segments or models which together create the ECL framework. What we'll do is we'll give you a quick overview of how typically monitoring is done for the different models that we see here. So if you go to the next slide now, you'll see it here that first, if we talk about staging, the most in focus practices, both quantitative and qualitative, we spoke about, and this is something which we have built using our experience of working across different countries with different banks and with different regulators also, that which are those monitoring practices that are most recommended and most expected out of companies who are doing ECL models. So from staging perspective, quantitatively, the first one is stability analysis. Essentially look at the composition of your stage 1, 2, and 3 and how stable they are in different periods and whether that matches to your business expectation about that stability. Second is sensitivity analysis. Especially in the UK, it's very common to evaluate that how many loans moved directly from stage 1 to stage 3. Because the expectation of the standard is first it moves to stage 2 and then to stage 3. If loans are, especially wholesale, if they're moving directly from stage 1 to 3, the proportion of such loans are significant, then it brings into question whether your SICR criteria is actually good in terms of, kind of analyzing risk at an early enough period and putting them in stage 2 or not. And third is the curing period, which is essentially that when do you take loans out of stage 2 and 3 into stage 1? What's that period of, the curing period of what's sometimes called a probation period that you keep loans. And for this, you typically quantitatively, you'll want to calculate the redefault loans, the loans that default and are cured. What's their probability of defaulting again, and whether that's in sync with other loans in stage 1. So redefault rate calculation is something which is recommended for staging. Qualitatively, extremely highly recommended one is whether our SICR criteria, whether our staging criteria has forward-looking information in it or not. Of course, the benchmark of staging is that 30 days past due is what, takes loan to stage 2. But essentially what the regulator expects is that you should look at expectation, of individual customers, looking at the current economic state, looking at the forward expectations about that industry, about that, profile of customer, and then proactively move loans to stage 2. So whether your staging incorporates forward-looking information or not is something which is regularly being questioned. And we have seen over the last 2 or 3 years, people, banks have made specific effort to incorporate forward-looking information in their staging policies. The next one is low default, low credit risk. Regulators are now kind of saying that low credit risk exemption is something which you should not use, generally speaking. It is more of an exception. And what we have seen is the practice of using low credit risk exemption has also come down significantly over time. When first ECL models were prepared, a lot of them were using low credit risk, but with regulator feedback and, otherwise it's been that less and less people are using it. And if we are using it, then of course the obligation to justify it becomes important, to monitor it regularly becomes important. And third is, of course, alignment with risk management monitoring. Now, in a particular organization, there might be, other indicators of stress which may be tracked by other, departments or functions. It's important to integrate that to ECL models also. So if we have any, let's say, indicators of stress in certain portfolios, like for example, certain credit cards, we block them in case of certain situations. We do a temporary block on certain credit cards, let's say, in case of certain type of transactions or whatever. Then that might actually indicate that such customers might be at increased risk, in which case you might want to move them to stage 2, not wait for 30 days past due. So regulators are expecting that you align your ECL staging policies with, whatever risk management practices or monitoring that you're doing. Moving on some of the PD-LGD model, typically there are 3 things that we quantitatively recommend checking. One is the discriminatory power. Essentially what you do here is determine whether, let's say I'm using ratings to group my customers and then I'm, applying PD on them. So whether the ratings are discriminating between good and bad customers appropriately or not. So there are a few tests which you can do to check it. Gini coefficient, AUROC are some of the most common tests which you run to determine whether discriminatory power of your models is appropriate. Second is calibration accuracy. The most commonly used test here is binomial test, which helps you analyze whether the actual ECL results from your model, actual PD that you have seen, whether it's within an acceptable range or not. So what binomial test would do is it would tell, okay, as per this test, your ECL should be within 1.5 to 2.2%. So this gives you a range. And if your actual results is, let's say 1.8, you're within range. If it is, let's say 2.5, then you're outside range. So it's a good test and a very, commonly used test to evaluate whether your ECL models are giving the right results or not. So binomial test for PD is most common. You have IV tests and others also. And then the third one is population stability, which helps you analyze whether, the nature of loans that you have, the population of that, whether that has stayed stable over the period. If not, then there might be a need to recreate models because your portfolio has changed. So your model should also reflect that. And PSI test is, the most commonly used here. So those are quantitative tests which are recommended for PD models. Qualitatively, I think an important one is looking at whether the definition of default has been consistently applied or not. Reasonableness of any external data or benchmarks which you have used, whether they remain reasonable, still, and whether segmentation is intuitive in line with business understanding of your portfolio or not. LGD model, again, discriminatory power, calibration accuracy, population stability. Spearman rank, MAD are two very common ones to look at calibration accuracy when it comes to LGD models. And then qualitatively, you talk about, what you're treating as technical defaults, what you're treating as restructures, whether that's in line with, what it's expected, in terms of default. Treatment of credit enhancements, different types of collateral, different types of, let's say, guarantees or other credit enhancement which you have. Their treatment in the models, qualitatively, it's useful to check that. Cured loan assumptions, intuitive segmentation, these are some of the other qualitative things we consider. When it comes to macro models, a lot of them would be some, kind of a regression-based model. So regression assumptions around, multicollinearity, around normality. If you've used, multiple variables, you need to make sure that, regression assumptions are something which stand true over time. Model stability correlation needs to remain strong. Sensitivity analysis is very important. It should not be that, we are using certain variables where if you make certain changes in those variables, the results are completely unreasonable. So a sensitivity check is always important and recommended in monitoring. Qualitative is much more important though in macro models. Looking at business intuition of the variables you have used and the relationship that you have justified. Granularity of segments, we'll talk about it a bit more. Benchmarking, scenario justification. If you have used lags or transformations in the model, whether they are reasonable and as expected or not. EAD models, again, you have these things. So the point is that there are a lot of well-established validation tests or monitoring tests which have now, been followed. And it's important to consider, the policies which currently are being used by different organizations and see if some of these are missing, in which case to incorporate them. That would help, of course, create a much more robust monitoring framework for your ECL models. If we move on to the next slide now, we'll talk about something which, auditors typically really like to see, which is an overall level backtesting. What happens here is that, you consider what the ECL was, let's say last year, let's say 31st March 2023 was my last year, and an ECL of 13.4 million, let's say, broken down into different stages. So 6.7 million in stage 1, 1.3, 5.3 in stage 3. So you look at what the ECL was that you created last year, and then you compare it with the losses which actually came in over the last year. So how we look at is okay, how many loans went into default, how many were written off, and accordingly, what were the losses. You also consider the recoveries from loans which are written off. Like you can have post write-off recoveries also, incorporate all of that. And ultimately, you like to see that over the last year, how much were actual losses in comparison to the ECL, just to see whether you were under-provided or over-provided at a different stage level. While, of course, monitoring at a sub-segment level, like we saw in the previous slide, is recommended and usually followed also. This one is more for just getting an overall comfort on whether we are over or under provided or adequately provided, and especially commonly recommended by auditors, statutory auditors for ECL models. So yeah, a combination of these two, overall level backtesting and the model monitoring practices we saw in the previous slide, in combination is something which can really help create a robust ECL framework. Let's move on to the next slide now. What generally comes out of a monitoring report, these are typical recommended practices on how a model monitoring report should come out with. It's very common to use those traffic lights or some indicators of what level of observations they are. If they are green, you leave it unchanged. The first yellow indicates that a temporary adjustment might be useful because the issue is like isolated or limited to a particular period. The next yellow is that you may need to recalibrate the model because there's a model drift, let's say a population shift which has happened or something. The blue is that you have to redevelop a new model, and the red is that you have to withdraw it completely. So depending on how severe the model monitoring results are, the outcome of that really tells you then what next essentially has to be done. Move to the next slide now. In focus currently is also what kind of model monitoring do you do on model selection, scenarios, and overlays, because these I think are the most sensitive in terms of determining whether your models are right or not. In model selections, what's recommended is that you continuously assess your current model against candidate models. Think of it in this terms as when we are creating macroeconomic model, let's say you start with 15 macroeconomic variables, and then you created a model which uses 3 out of them, right? With certain lags or certain transformations, let's say. So you end up with that model. What's expected is that you continuously evaluate if there are other macroeconomic models which uses different combinations, which may actually be more stable or which may have better accuracy over time. You compare results to candidate models. And then if it is that, there's honestly an alternate model which can be better, an improvement, then we select that model as opposed to the current model. So evaluating candidate models is something which is recommended. Next one is scenario analysis. Any scenarios that we have built, validating assumptions of that, reasonableness of that is critical. And what we have seen is that often scenarios have to be overlaid with expert judgment. You cannot simply go with a statistically driven scenarios. You have to look at reasonableness of that against, let's say, the broader consensus or commentary around current situation. And you might need to do an overlay by expert judgment just to make sure that they are reasonable and intuitive in the sense of expectations. And the third one is on management overlays. If there are post-model adjustments which are done, it should be backed up with understanding of model limitations. What is it that necessitated that post-model adjustment? Governance, internal controls needs to be extremely strong on this. And you have to quantify the impact of the overlay and, make sure it's justified basis the situation that you had. Move to the next slide now. Yeah. Now, what we discussed so far is, general frameworks, what's expected, regulator expectations, all of that. Now we'll have a discussion around where is it that we have seen models typically go wrong. And in the current situation where we have quite a few, evolving things, dynamic things in the economy at the moment at an international level, how is it that we can address those, right? So we'll talk about them. So where do traditional models generally fall short? If we go to the next slide here, we'll see that, your models, of course, are like this, that you create your models first based on historical data, and then you make the forward-looking adjustment. I mean, honestly, what we have seen is that if we have used the good practices in terms of building models, the PD, LGD, EAD models, those are generally quite stable over time. Those are where it's not so difficult to justify that we are doing the right stuff. It is the forward-looking adjustments, the most subjective ones, where we see that if the monitoring says that you have a model drift, if it says that your results are not in line with the forecast that you created, it is because the forward-looking adjustments may not have been done appropriately. What you do in forward-looking adjustment, of course, is you look at macroeconomic data, model impact to portfolio, create multiple scenarios, and so on. So we'll talk about forward-looking adjustment, and within that, why is it that things may go wrong. So if you go to the next slide here, forward-looking adjustments typically can be categorized into two buckets. The first one is the adjustment which you make for known or conventional risk, like your GDP, inflation, property price, unemployment, these kind of variables, which are, conventional known variables of risk. And the second one is novel risk. Novel risk are those which are not really something which, there's a tracker for that, let's say. These are risks which may come in once in a while. Like COVID, of course, was a very novel risk. There's no forecast or anything for when COVID would happen. It just happened. And then there are certain new risks, which are emerging now, which we do not have a precedent for from earlier. So it's very difficult to really predict what would happen in those situations. So those are like environmental risk, because environmental risk, of course, is something new that we are facing. And geopolitical risks, of course, are very dynamic. They come in that sense. So these are those novel risks. And currently, of course, a tariff situation, tariffs being, counter tariffs, and then, also supply chain restrictions and, all of those problems that we are facing also can be categorized as a novel risk at this moment. So how do you treat both of them? So if we if we click next on this slide, we'll see here that a conventional risk, typically you would do a macroeconomic modeling for. There's now established practices in terms of how do you do macroeconomic modeling. So you follow those, deal with the conventional risk, the risk of GDP going down, inflation going up, all of those things. You deal with macroeconomic modeling. But how do you treat novel risk? That is where, people face trouble in incorporating it in macroeconomic models. And we have seen more and more companies, more and more banks, honestly, having to resort to post-model adjustments or overlays to honestly do it in a reasonable manner. Now, I mean, while it's fine that a geopolitical risk, you say that, okay, let me make my GDP a bit more conservative for that. But honestly, it's really difficult to predict what would be the impact on GDP in that case, whether there's an impact, what's the probability. It really is very tricky to incorporate it in macroeconomic models. Especially so because these are risks which have not happened in the past. So how do you model results of past and predict the future if it hasn't happened in the past? So you have to then use judgment, overlays, post-model adjustments to do it. That's where overlays become an important source. Now, if we go to the next slide, the key pitfalls that we see in our models is that over-reliance on historical data. Now, it's very commonly thought of that you consider data of, let's say, the last 5 to 8 years, at least one economic cycle you consider, and that's a fair thing to do, right? But what we have seen is that the entire historical period may not actually be representative of your portfolio today. There might be regime changes, there might be changes in your underwriting, in the kind of customers that you have, the kind of products you have. There might be changes which may have happened over this period, because of which it's not that you take an average of the last 8 years and say that, okay, this is my average PD in a normal scenario. There are, changes which would have happened, because of which you can't really rely on historical data as it is. So what we're seeing is that, having to adjust that historical data to make it representative of the portfolio today your current conditions of your portfolio is extremely important. It may mean giving different weightages to loans in different period. It may mean doing a sub-segmentation of your portfolio and let's say removing data of a particular sub-segment, utilizing data of the remaining part in that sense. The next one we see is over-reliance on quantitative test. Quantitatively, let's say it says model is failed or model is accepted, but really, it is credit risk. It is extremely complex. You can't really rely on quantitative test blindly. It's just a initial reference point, and then you have to really see why it's saying yes or no. The third one is very important, which is and this is where regulators are really, really giving a lot of commentary. It is insufficient breakdown of forward economic guidance at industry or segment level. So I'll give you an example. Let's say, we anticipate a trade war. Let's say we anticipate tariffs to come in. Now, it may not necessarily have a drastic impact on GDP as a whole, right? GDP is a very broad indicator. It may not really have an impact on it for the next 2 or 3 years, let's say. But there might be certain customers who are extremely export reliant, on whom it can be, a very immediate and a very disastrous situation. So really, what's important here is that we do not look at, let's say, a GDP overall and say that, okay, we have done our job. It's important to break it down at industry segment level, analyze all of these additional information also, so that we are able to appropriately consider risk, which might be there at different subsegments, and incorporate it when we are creating our ECL. So these are the key pitfalls we have seen. And the last and the second last bullet point honestly go together. And this is in focus by regulators like big time at the moment. Move to the next slide now. Okay. This is a research which was done that how much of ECL is actually overlays. And what we saw is that initially when people built model before 2020, the proportion of overlays was quite less. Generally, most of the ECL was out of the models only. The post-model adjustment overlay was quite less. But in COVID, of course, people created a lot of overlays. So we can see in December 20, 0.1 out of 0.47 was actually through overlays outside of the model. And then very interestingly, what we saw, and regulators have also commented on it, that the amount of overlay actually remained quite stable since then also. COVID, of course, is like hopefully long gone now. In which scenario, of course, the initial overlay you created in COVID, one may think that it's not required. But how people have done it is they have retained these overlays, but recharacterized them. First, it was, initial 2 years, we can say it was COVID or possible return of COVID, because of which we are creating overlays. Then, of course, the Russia-Ukraine war happened, geopolitical risk that arise because of that. Then, of course, other reasons that you say, maybe something like a mortgage cliff, maybe something like high interest rate scenarios and what can happen because of that. So, you recharacterize the overlay, call it something else, but retain it. And one of the things which, people have started to ask is whether it is profit management, whether banks are really doing it just to, have a consistent and less volatile number for ECL. So those questions have started to come in. What we have seen, of course, is while it remains 0.10, which is exactly the same number across 3 or 4 years, at banks level, in some banks, of course, people have changed it. So it's not that every bank remains at exactly the same level. There has been changes at individual bank level. But somehow, if we look at European banks as a whole, which is what this study is on, somehow it has remained stable, which is, of course, quite interesting. If we move to the next slide now. Yeah. Then we see that where is it that the overlays are most required, right? The first one is corporate. If we see, the green one, on average, people have around 25% overlays. So the amount of ECL which is because of overlays is 25%. In case of corporate portfolio, 75 is out of model, 25 is through overlays. But the variation is quite big. There are certain banks who have 0% also, certain who have like 65% also. So there's quite a lot of variability and dispersion in terms of how much overlays different banks have used. On average, it comes to 25%. What we have seen is typically on SME portfolio, people have carried a lot of overlays. On corporate also, they have decent overlays. When retail, as can be expected also, the amount of overlays is much less. So if we look at the next few, the mortgages and some of the retail portfolios, the overlays is like around 10%, while in others it was much more. Methodology followed for estimating overlays. However, people creating overlays, expert judgment is the most common one. Internal stress test is, again, the next one. How we do internal stress tests, of course, is we create scenarios, identify what can happen to our portfolio in those scenarios, and say that, okay, this scenario is possible. Let me create an ECL overlay for what can happen in that scenario. So an internal stress test resulting in an overlay. A sectoral assessment is being followed by 6 banks here. And then, some of the other techniques are there. But expert judgment remains a very integral and indispensable part of how you're creating overlays for sure. We move to the next slide now. Regulator expectation while you're creating an overlay. The first one they say is it needs to have a very structured approach. There needs to be a trigger why you are creating an overlay. A need needs to be there, and you need to really address it in a very structured manner. You can't simply go with, okay, I'm just doing an overlay of $5 million just because that way is not possible. Second, they say it needs to have a very strict governance process and internal controls. It needs to be debated, discussed, deliberated, analyzed at the highest of committees that you have for governing ECL provisions. And the internal controls also needs to be very, very strong around this area. This is where, regulators have found that the banks needs to improve. And, we see this being in focus by a lot of clients of ours also. It needs to be tailored to specific risk factors and expected to be at a sector level. We have, of course, discussed the reasons why also. If we move to the next slide now. Yeah, impact of evolving macroeconomic and geopolitical risk. If we look at, current situation here, evolving risk, trade wars, supply chain disruption, we had a bit of it earlier also. Climate change, of course, is going to be a theme. A possible US recession and geopolitical instability could again be possible risk. How to address? It's important to identify at which level it's going to affect us, whether it's going to be PD or LGD or CCF or, which segment, which level. Should you incorporate in your SICR by, let's say, putting more loans in stage 2? Is that how you'll address it? Do you want to do an overlay, or do you want to actually incorporate it in the PD-LGD model itself? So first is that decision. Second is identifying if you have any stress test which was done internally to evaluate impact of those scenarios. Third, you identify the vulnerable sectors within it. So let's say, we spoke about trade wars. If you have certain customers reliant on exports, it's important to identify those customers, before applying it. You may need to update your ME macroeconomic forecasts and scenario weights in those kind of cases. And also something which is becoming common now is incorporating some of these things in your scoring systems or rating systems or making a qualitative adjustment in it. So for example, let's say a more vulnerable sector because of climate risk, let's say has a more conservative rating or score from your scorecard or ratings. And that, of course, then automatically reflects in your ECL also. So if you're able to do it in your scorecards or ratings, which some banks are trying to do now, incorporate some of these novel risks also in the questionnaires or rating methodologies that they have, then it can really help address the ECL question also in that sense. Moving on to the next slide now. We see a bit about how people have done it, in a very recent past. So we, of course, had Russia-Ukraine conflict, and in first half of 2022, how did people address it when this whole started? We see that most of all, like for banks who did address it, 26 banks actually reflected it through overlays, did not make any model adjustment, created an overlay for it. 18 of them adjusted their macroeconomic scenarios to incorporate a change because of this. For 5 of them, it was incorporated in SICAEW. They identified a few customers, took them to stage 2. That's how they did it. And then 4 of them, they were reflected at a IFRS 9 parameter level. What that means is they changed their PD or LGD, right? They changed it, affected that in that sense. For some, it's not there. And then only one bank was there who actually did not reflect it. This is again European banks, analysis based on that. The question that comes is, now we are talking about tariff wars, possibly. It is then, of course, a question for us, should we address it? How should we address it? And I think this, this slide really tells you how people generally end up doing it, in similar situations, like new kind of risk which is coming. We move to the next slide now. The second is industry practice on climate risk. Here we see that a lot of people actually have still not addressed it. So if we look at 2023, this data is actually from December 21 that they did. There's only one bank who had addressed it in the macroeconomic scenarios, one who had addressed it in another way. So you see the blue and the red, the only one bank here. For 18 banks, it was under discussion. And for 15, ESG or climate risk was not even considered. So this was a situation around 2021 or something like that. But if we see now, right, today, 55% of the banks have actually incorporated climate or environmental risk in their ECL models, as compared to 16% like hardly a year or two ago. So a lot of more banks have included this. And the question is, how have they included? We looked at the framework, looking at identifying vulnerable sectors, affected sectors, creating scenarios. So just to give you an example, let's say, I have certain industries which are, contributing to pollution. Let's say I have, customers which are, in oil and gas industries, or which are in, let's say, automotive industries and all of that. And, I see a risk of a possible regulation which may really impact their liquidity or impact their business significantly. So then, I can identify that, okay, what can be the fallout of climate risk? Is it a new regulation that comes in? Is it that, it might be a more physical risk to certain industries or type of customers? In which case, after identifying those customers, you identify how much additional risk can incorporate in that way. So a lot of banks have started to do it. As I've shown here, 55% of banks actually have done it, while it was just 16% in 2023, which you see in the graph on the left. So, it's very actively being looked at by banks at the moment. We move to the next slide now. The next one here. Good and bad practices. I think we have spoken about some of these, and we have quite a few questions. So what I can do is I can maybe skip this slide, leave it for you all to read later when we share the slides with everyone, and move to the next one for now. Q&A. I think it's up to go to the Q&A section. Polly, over to you if you can help us with the questions that have come in.
Excellent. Thank you so much, Jatin, for giving us such a great overview, and Vivian and John as well. So we've had a few questions come in. Please keep them coming. Also upvote any questions that you think we should answer first. So the first one is from Ritesh Mistry. I was interested in the earlier comment about regulators seeing different PDs at different banks for the same counterparties. Can we expect to see changes here going forward, i.e. regulators forcing banks to have the same PD for given counterparties? If so, I can see this being quite challenging for the bank. So that's a very interesting question. Not sure who would like to take it. John? John's volunteering. Great.
Thank you very much. Yeah, I'll just clarify some language there in terms of, is it the same assets? I think more precise language might be similar assets. So it might be lending to the SME sector. And they're seeing different PDs for similar lending to SME sectors in particular geography. Now, of course, some of those differences might be totally explainable by different credit policies. If you have different LTVs that you have in different banks, if you've got different EBITDAs you expected, all of that may mean you've got different lending, and the PDs will be explainable and different. But they're also seeing differences in IFRS 9 versus your IRB PD estimates. Why is that? Again, some of that might be explainable because there's different definition of defaults for different models and there's different timelines, 12 months lifetime, for example. So there are some extreme differences. But I think the regulators will still be interested in those differences. I see two things that they're going to do. They're going to continue to apply scrutiny to this area. So I can't see them prescribing PDs per se, but I think they'll continue to be interested and try and understand those differences and whether they're explainable. I think for banks, it means that you need to monitor these models, look at how well they're performing, back testing them to see, are your SME models performing as you want them to? Do they require any of the overlays, PMAs that Jacqueline's spoken about? Hopefully that helps answer the question.
Great. Thank you, John. Vivian, Justin, anything to add to that?
Yeah, no, I can just, honestly second the question in that sense that what we've seen regulators also challenge is that, let's say there's a customer I am funding and I only have a foreign branch in another country who is also funding that customer. They also want us to now consider that at a group level, let's say it's a, it's like, let's say BP or Shell or some very large group, which has, different countries that they are in, different subsidiaries, let's say. They also want consistency in how you're rating groups in that sense, with, let's say your branches in other countries, if you're rating them. So we are seeing a lot of regulators emphasize on consistency between different banks, between groups in that sense. And where they are focusing a lot more on is evaluation of the rating models, ensuring that they're consistent across, let's say rating models which a Moody's or S&P has, whether you have benchmarks against that, just to make sure that your rating is also consistent with broader market or not.
Great. Excellent. Thank you, Jatin. Vivian?
Yeah, no, absolutely. I think the theme there is consistency. That's the message from the regulators. So if you have that front to mind, then the conversations is always very useful. So consistency is the theme.
Excellent. So consistency, definitely. We probably have time for one more question. So Eva Nito asks, for how long does a risk need to be crystallizing before it is not considered, I think she means novel anymore?
Yeah. So tricky one. So novel risk, typically what we categorize as a risk which we have not seen in the past. So like COVID is something which we hadn't seen before COVID happened, right? So we consider it a novel risk because we can't really predict basis past results or past situation. If we have seen that risk, if we have a similar situation having happened in the past, we would recommend that we utilize that experience to predict for the future. Then it may not be like a novel risk because it has happened once before, let's say, or a similar thing has happened once before. So you can use experience from there and then use that for your models now. So I would say that if you can, relate your current risk with something that has happened in the past, it may not be a novel risk. And if you can't, there's no precedent, there's no experience of something like that, then it might be a novel risk.
Great. Thank you so much, Jatin. I'm really sorry, that's probably all the time we have for questions. Concludes today's webinar. I'd like to thank our speakers for their insights and advice. Thank you, Jatin, Vivian, John. I would also like to thank you, our listeners, for your time and for your questions. I hope you have found this session useful. If you enjoyed this webinar, we are pleased to say we have not one, but 2 more webinars scheduled for June. The first one is on 10th of June and is on the topic of navigating the quantum threat, ensuring encryption security. This is going to be a fantastic one. Really excited to be hosting that. And the second we have on the 27th of June is looking at IFRS 17 insurance contracts. A short feedback survey will pop up at the end of this webinar. Please do complete this as your feedback is very important to us and helps us shape future events. Just a reminder that a link to access this webinar on demand, along with the slides, will be sent to you via email within 24 to 48 hours of this webinar. Thank you very much and goodbye.
Thank you.